With the Federal Reserve refusing to raise interest rates, we continue to wander in the uncertain financial system. With massive levels of debt piling up globally, even the IMF, the economic police force for the elite, shares these concerns. Fasten your seatbelts. We're in for a bumpy ride. You came here for the truth, so let me unveil that for you. Historically, October is the most volatile month over the past 20 years, so we could definitely see this trend continuing. We're going to discuss so much in this video today. I have a lot prepared out of Bloomberg. Here's some advice for investors hoping for some calm after the recent stock market volatility. Expect the unexpected and get yourself used to bigger swings. Even though the market has a positive bias and we're looking for a fourth quarter rally, it's going to remain volatile. Now, a rally, where in the world would that come from? Because somebody's got to print money for that to go up. I don't believe that this is going to be a natural occurrence. There's no reason for that. Every reason is going downward. We're seeing all the stats add up. So why in the world would we see a rally? Over the past 20 years, October has been the choppiest month for stocks. This year may follow the pattern of 2011, 1998, and 1990, when steep declines in August were followed by further downdrafts in October. We are in an important seasonal stretch. This time is very volatile. We're not done. The repair process takes many months and all that, blah, blah, blah. What they're trying to say here is that, hey, don't worry, don't get excited, don't get nervous, keep all your money in, and as the market continues to fall, that's okay. Just don't panic, that's all. If you panic, we're not going to be able to take our money out before you do. That's the way this works. It's all propaganda, pretty silly. Out of CNBC, the U.S. Federal Reserve thought the economy was close to warranting an interest rate hike in September, but policymakers decided it was prudent to wait for evidence of a global economic slowdown wasn't knocking America off course. Yes, once again, they're making it seem like this is the first time this has ever happened. They were going to raise rates, but they didn't want to just in case. Sure. They make it seem like the economy is so strong and, this time we're not going to do it, but next time we promise we're going to do it. This is from the minutes from that meeting in September, basically saying that they were worried and they're concerned about this global economic slowdown. Now, if I say that, I'm considered a fearmonger, but if the Federal Reserve says it, then it is some sort of religion. Nevertheless, in part because of the risks to the outlook for the economic activity and inflation, the committee decided that it was prudent to wait for additional information. That's according to the Fed's minutes. Now, what information are they looking for? This has been years. It's at 0%, but it's been years like this. They are looking for some sort of unicorn to appear out of the sky, and I think they're going to be waiting quite some time longer. This is out of the Telegraph. Governments and central banks risk tipping the world into a fresh financial crisis, according to the IMF, as it called a time on a corporate debt binge in the developing world. We're talking about the emerging markets, a concern that I've had as well, but it's not just the emerging markets, it's everyone. Emerging market companies have overborrowed by $3 trillion in the last decade, reflecting a quadrupling of private sector debt between 2004 and 2014, according to the IMF. That is huge. You cannot deny that. Not enough, basically, backup here for $3 trillion in a 10-year period. This is going to show you, and I'll talk about in the next paragraph, the dangerous over-leveraging is now threatens to unleash a wave of defaults that will imperil an already weak global economy. And you're looking at this weakness here, and everything would be okay if the stock market would go up, if the unemployment rate would go down, if debt would go down, the deficits would go down, if the printing money would go down, and jobs were abundant, and everything like this. But that's not the case. So we don't have a method of getting out of this mess. There isn't a method of it. Is there any country that's doing so well that it's going to be able to bail everyone out? Germany thinks it can bail everyone out in the EU. Meanwhile, it has its own problems. Surely not as bad as many of the other countries, but it's not without its own problems. Right here. The fund warned that there was no margin for error for policymakers navigating the risks. Look at this. The slightest miscalculation could collapse into a failed normalization of interest rates and market conditions, wiping 3% from the world's economic output over the next 2 years. I'd like to say it can get a lot worse than that in a much quicker time. But they like to be conservative. But we need to take what they say and understand that at least some of it is very realistic and very probable. Now, they're suggesting that, if they do the interest rates incorrectly, they're going to have a big problem. But if they raise them at all, it's going to cause a problem. The market can't sustain this. They have to go to negative just to keep the system going. This is the actual IMF report. I always show you the actual statistics themselves, the reports, the white papers, what have you. And this is from the IMF's own website. We're talking about financial stability. Apparently, this is according to them, has improved in advanced economies since April. But the risks continue to rotate toward emerging markets. I highly suggest reading this. It's a very long paragraph here. It tells you some good stuff. And I'm not going to read it all. You'll fall asleep. But the prospect, this is interesting, the prospect of U.S. Federal Reserve gradually raising interest rates points to an unprecedented adjustment in the global financial system as financial conditions and risk premiums normalize from historically low levels alongside rising policy rates and modest cyclical recovery. Okay. Just the prospect of increasing interest rates affects everything down the line. How many times has the Federal Reserve increased interest rates since they brought them down to zero? Of course, the answer is zero. 0 times. They've never done it. Never done it even 0.25% and had to bring it back down. Never a little bit. There has been no increase in the interest rates for years and years on end. What makes you think that all of a sudden they're going to increase them when they have no ability to do so? If they do, we're in for a big mess. No, surely. Perhaps it could withstand a very small percentage point increase for a short period of time, but that will catch up to them. But what I'm trying to mention here is, without getting on and ranting, the prospect, they haven't even done anything and they can affect the market so dramatically. What does that say about the fundamentals about the market itself? There is no market. It's computer algorithms, high frequency trading, and a bunch of garbage. Let's look at this. Out of CNBC, Wall Street is getting increasingly nervous about, again, the prospects for recession, both on a global and domestic level. You're looking at the slowing global growth, and the numbers that they claim are so fraudulent, but let's pretend that it's real. Look at this. The 73.5 trillion global economy is expected to grow 3.1% in 2015 and 3.6%. They always say the next year is higher because they're saying, well, this year, it's not going to be so good, but next year, oh, trust me, it's going to be great. They've been doing this, and I've been paying particular attention to this type of fact since the recession began, and which has never ended, but anyway, since the recession began, and it seems to be a continuing trend. They have fun with this. It's never the case. According to the latest IMF predictions, those numbers, though, are heading lower and could be revised even more before it's all said and done. That's how it always is. It's a joke. This is, I think it's comic relief for me. Unfortunately, it shouldn't be. Now, for those who don't know, and perhaps I need to do an entire video about this and add it to the e-course, this is the GDP. It's an oversimplified diagram that I use in my book. GDP equals government spending plus consumption plus investments plus exports. All of these things. Now, the government spending, I think perhaps that's been increasing if you look at all the Medicare, Medicaid, all of the social assistance programs, but many of them are off of the books. Consumption, investments, and exports, well, exports are down, imports are down, investments are down in many ways. Consumption is down. We have the lowest consumer confidence, despite the fact of what they keep telling us. The amount of consumption is down in many ways as well. The GDP is declining. It's a negative. I'm not willing to take the GDP numbers that they provide at face value. I can't believe them any longer. Now, if you are able to save up money, if you're able to do that consumption that they claim, well, things are changing. Taxation is increasing, and this is one example. Medicare Part B premiums to rise 52% for a whopping 7 million enrollees. So they said you're not going to pay a dime extra what you do now. Guess what? You're going to pay 52% more. And this is just a small thing, and this has been happening, in fact, since they've introduced these Obamacare and everything else. They're going up in price. They tell you that everything is stable, everything is fine. They go up in price. But what happens to the care? It gets worse. It gets worse as time goes on. They use all the money for, quote, research, but nothing ever gets solved. People are getting more sick now today than ever. There are more viruses and all of these types of advanced strains of bacteria more now than ever before. The world's in trouble. Last but not least, just wanted to touch on this. Urban Outfitters, the store, it's a clothing store, and basically what they're saying is cool weather coming. That means a new rush of customers going to retailers such as Urban Outfitters. They had an email yesterday explained to salaried employees its strategies for keeping up with this rush of people, trying to get them to work for free on the weekends. That's the email on the gray part below, and basically it's saying, look, help out, help the company, have a good time with your friends at work, and work for free. Now, this is just a small thing, but I think it goes to show you the value of you as a person. Now, this is all going to be changing as they replace these people packing these boxes with robots, with an automated services, and the shipping. Imagine you'll have a robot packing the boxes, and you'll have an automated vehicle delivering those boxes. That's what's going to happen. So people gladly take on this volunteer, as they call it, because they don't want to be the first one to be axed when the robots come into place. That's the way I see it anyway. If you found this video informative, please give me a thumbs up. Remember that thumbs up helps me out. It helps spread the message out. If you don't want to share this on your Facebook or Twitter or what have you, then it is imperative that you give me a thumbs up. I do appreciate that, because it basically pushes the search results up higher. So the Money GPS will come up higher in the search results. So once again, I do appreciate that. If you found this video informative, then I know you will find my book, The Money GPS, even more informative. Flip through it over at Amazon, click on the Look Inside feature, and take a look for yourself. Take care.